Singapore intends to achieve its economic growth target through improvements in 1% from the workforce and up to 2% from productivity. Deputy Prime Minister and Finance Minister Lawrence Wong says this will require firms to learn new ways to do business and workers to pick up new skills. He was wrapping up a three-day debate on the recent budget, which drew comments from over 60 members of parliament. Sabrina Ng reports.
A global pandemic and major geopolitical conflicts. These developments pushing prices up globally, not just in Singapore. In fact, inflation figures last year could have hit over 6% if it wasn't for monetary policy moves that strengthened the Sing dollar.
We are going through a rough patch of higher prices due to forces well beyond our control. We are not the only country facing these difficulties. The government will do everything we can to help households and businesses get through this rough patch.
And against rising costs, Mr. Wong says the best way ahead is for businesses and wages to grow in real terms. That will require a continual transformation of the economy, which is why a key strategy is to attract more high-quality investments into Singapore.
These investments typically involve cutting-edge and innovative activities. They help to push the productivity frontier. And that's why we need new investment promotion toolkits like the refundable investment credit. Another strategy is to maintain consistent and steady investments in R&D.
DPM Wong says there are concerns about whether Singapore will become a two-track economy, with different policies for companies based on their size. But he says small and medium enterprises and their larger counterparts should be seen as two broad segments of the economy. One that is domestic-oriented and another that is outward-oriented.
Companies in this outward-oriented segment are generally more productive and also have some scale. They have to be. They compete in the global marketplace. They must continuously innovate and up their game. Otherwise, they will fall behind and they will lose their share of the global market. Not surprisingly, these companies have high take-up of government schemes that help them invest in R&D, automation, and productivity improvements.
These NMCs account for about 75% of Singapore's economy, with SMEs making up the rest. Some sectors, like retail and construction, tend to be more labour-intensive, making them less productive. DPM Wong stresses that this is not something unique to Singapore, and so there's a need to support smaller firms along their transformation journey.
Of course, within our domestic-oriented sectors, there is a range of firms. Some are embracing change and restructuring themselves to be more productive. Others are less ready to do so. And that's why we can and we must do more to encourage and support companies, especially SMEs, in this restructuring journey.